It's time for our 360 round, and we're looking at today's CPI data, right? So you saw the number come in, and it comes in with less inflation than expected. That's the big picture and the takeaway. So let's see what our guests have to say about this. Joseph Wang is here, CIO, MonetaryMacro.com, and Jay Hatfield, CEO, CIO, Infrastructure Capital Partners. Thank you both for being with us. Jay Hatfield, what was your interpretation here? The core CPI comes in, it's disinflationary, people like that. And in fact, I just saw how tech stocks got a big bid. People got excited over this number. Is there something to be excited about?
Well, yes, the big swing was in transportation services, and that rose a disconcerting 1.8% last month. So that's a 24% annualized rate. So that was very positive. What wasn't so positive is that shelter remains elevated at 0.3. We have an alternative way of calculating CPI using real-time data. That number year over year declined to 1.7%. So we have a differentiated view that inflation's already contained. The Fed should ignore price increases from tariffs because they're one time. It's like a sales tax. And the Fed is behind the curve and needs to cut rates, or else growth will continue to decelerate and eventually we'll have a recession.
It's interesting because you're not the first person to come on and say, look, the meeting next week on the 18th and 19th, they should actually cut. What say you, Joseph?
Well, first off, thanks so much for having me, Nicole. So I think Jay makes a very good point. Now, CPI was a little bit cooler month over month, but we have to be careful now. What the Fed looks at is not CPI, but PCE. So when you look at how CPI feeds into PCE, that PCE number, core 0.3% month over month, is the estimate right now. So on a PCE basis, it's not super cool. However, on the bigger picture basis, I agree with you. I think inflation is last year's story. Now, what we learned from 2018 is that tariffs are very growth negative, and that overwhelms any change in the price level or inflation rate that may happen. So I think the Fed is going to cut more than the market is expecting right now. I think growth is the bigger concern rather than inflation going forward.
And how do you what's the takeaway here, Jay? I mean, if the Fed's not cutting fast enough, are you worried about the economy?
Well, I think that, Atlanta GDP of negative 2.8 is massively overstated. And it's important to keep in mind the first quarter is always slow. There's no Christmas, there's no construction. We had a cold winter. So we think people are getting too concerned. We were really one of the first to say the economy is weakening, but now we think people have overshot. And the one thing to focus on is, so the old economy is very weak, and investment is really critical on that side. And so actually the old economy has been weak for the last 3 quarters. But of course, tech is ultra strong. So our forecast is a 1 to 2% growth, but the Fed has to cut 3 times. We do think they're not smart enough to cut this month, but they will in the early May meeting.
Okay, so now at this point, Jay, by the way, are you buying dips? I mean, if you were saying how you were first to call maybe an economic slowdown, are you now buying dips thinking that you get a bounce back quickly?
Well, we said before the sell-off started that we were neutral on the market at a 6,000 target. And the way to use that target, of course, is if you are 10% below-ish, like 5,500. We think that's a decent place to take a shot, yes. But we would rather wait till April to get really bulled up.
Got it. Joseph, I'll give you the final quick word.
So I think Jay makes a good point. The Atlanta Fed GDP now was saying a negative 2% growth. That's overblown. The creator of the Atlanta Fed GDP came out and said that's largely due to gold imports. You take that out, real growth is about 0.4%. So definitely slowing significantly. Now, my target at December last year was S&P at 5,500 at the end of this year. So I think we have further lower to go. We're going to bounce back later in the year, but I would not be the buyer of equities right now.
All right, Joseph Wang and Jay Hatfield. Joseph, Jay, thank you both so very much.